today, and we're building on those gains throughout the session, up more than 1% in the S&P. Every sector is strong right now. Consumer discretionary is in the lead. Thank you, Tesla, which is up 5.5%. NASDAQ up 1.4%. Keep in mind, we're coming off of the worst week of the year with concerns about Fed tightening, more rate hikes, higher rates for longer, dominating the conversation still. Let's get back to Bob Pisani on some of today's big movers. Bob.
Down month, but an up year. That's sort of what we're dealing with. Things turned around in the middle of February, as Sarah mentioned. Rates moved to the high side. But she's right. There's no particular fundamentals behind this rally, but it is a strong one. All 11 sectors of the S&P are up this morning, and we have 8-1 advancing the declining stocks. That's a really strong rally. In terms of differentiators that are out there, metal stocks are doing well. That's always a good global indicator of demand. Retail, which has frankly had a lousy month, is also bouncing back. Banks, which have been okay, they're flattish on the month. Semiconductors, another group that's actually done very well. Tech generally has held up. It's about flat for the month of February. A lot of other losers that are out there. In terms of big movers here, Sarah's right. Tesla, you can thank the move up in consumer discretionary largely because of that. But Nvidia's just had a monstrously great month. That's been a big help to the semiconductors. But even Meta has had a bounce back. But this is not true of everybody. So, for example, Intel has just been horrible this month. As you saw, remember earlier, we had the dividend cut there. Alphabet has also not had a great month. Amazon has not had a great month. But all of these stocks are bouncing today. Virtually no losers out there in the big cap tech area. Cathie Wood's coming on. Good to see her down here on the floor of the New York Stock Exchange with us. We'll be talking with her in just a couple of minutes here. Note that she's got a lot of interesting ETFs that are out there, not just her ARK Innovation Fund, but they're all up. Everything's up. In fact, she's beaten the S&P right across the board, not just the flagship ARK Innovation, but the next generation, the space exploration ETF, the genomics revolution, which is very different kinds of stocks than in some of her other ETF choices, all of them beating the S&P 500. The main holdings there, which we tend to watch carefully for the flagship innovation, well, Tesla is just powering that whole little ETF there, up 67%. But these are the top 5 holdings. But even Roku's having a great year. Zoom Video is up 10%. Exact Sciences and Square all up. And again, Carl, these are the top 5 holdings for Cathie. So she's got to be very happy with the performance so far this year. Carl, back to you.
Bob, appreciate that setup. That's our Bob Pisani. And in fact, our next guest says she has never seen markets this dislocated and believes the most brutal rate increase in history is near an end. Joining us here at Post 9 exclusively is Cathie Wood, ARK Investment Management founder, CEO, and CIO. What a treat for us. It's good to have you back, Cathie.
Oh, I'm happy to be here, Carl.
Most dislocated ever. Ever's a long time.
Ever's a long time, but from last year, the bond market at one point had never performed as you had to go back to the 1700s. So long duration assets were creamed, including our innovation strategies. And it was all because of fears of inflation and higher interest rates. We do think inflation's coming down now. It always seems like it could come down faster, but we do believe it's on its way down. You listen to corporations out there, even those who have had pricing power, the staples, P&G, they get their pricing, but they lose the volume, 6% declines in volume for a staple company. So we do think the consumer is railing against inflation, and the Fed certainly is doing its part, and money supply growth is down. Our estimate is roughly 3% on a year-over-year basis. We haven't seen a decline in money supply since the Great Depression in the 1920s.
So you see these most recent hawkish hand-wringing as the death gurgle of inflation, one last attempt to try to make its voice known?
I think the Fed really wants to make sure that it has done its job, and job owning is part of it. But I do believe the equity market, certainly the way we've started the year, are beginning to see to the other side. And sure, maybe they go up another 25 basis points, maybe 50, I don't know. But I think we're just about there. And the market is a discounting mechanism after all. So if it can see to the other side, then we should be okay.
It was looking like that in January, but then January data all came in really strong, including inflation, with the PCE going in the wrong direction. So the market has sort of changed its mind from your view, and now thinks we're going to have a series of more interest rate hikes, and they're going to have to stay higher for longer, and the economy is going to get hurt worse than expected.
Yeah, this is going to date me. This reminds me of early in my career. In the early 80s, it was the same thing. But those who bet on lower inflation and interest rates long term were the winners. And it's always the data are very volatile, especially when you have the warmest winter in history here in the Northeast. So I think that's distorted the numbers quite significantly. And the interesting thing about seasonal factors, if that is the distortion, they all have to work out to 1 over the full year. So if they bumped the numbers disproportionately in January, it'll come out of other months.
I don't know. February's a little warm, too.
Yeah.
Some people look at your ARK Innovation Fund, Cathie, as a barometer for what the Fed is doing, right? And they say, it's back on the rise. Speculative behavior is back. Unprofitable tech companies are getting bid again. The Fed has more work to do.
You know, it's very interesting that people do link the two together. I think that the muscle memory has more to do with the tech and telecom bubble and bust and people fearing that we may be in the same situation. We are not. In fact, the seeds for everything that's happening today, all of the innovation that's happening today, they were planted in the 20 years that ended in the tech and telecom bubble. But the technologies back then were not ready. The costs were way too high. We didn't get the big breakthroughs in artificial intelligence until deep learning 2012, transformer technology 2017, and now finally we have a chat GPT. People are beginning to understand that the ground is shifting underneath us when it comes to innovation. Unlike in the late 90s, investors rushed into the late 90s, weren't ready for them. Now they're running away. They really are running for the hills. And what are the hills? They're benchmarks. That's where they think safety is. But if we're right, the benchmarks, which represent the traditional world order, are going to be disintermediated, disrupted by the most massive innovation period in history. So sequencing technologies, robotics, energy storage, artificial intelligence, blockchain technology, and they're converging. And, you know, S-curves feeding S-curves. But what's interesting to us is we don't have that animal spirits in the market chasing these. You might think in January, perhaps. But the technologies are happening, and the impact on our lives is going to be profound.
Are you referring specifically, in this case, to AI?
AI is really the mover and shaker here. It is going to catalyze more innovation because it's at the heart of the convergence between and among technologies. So autonomous taxi platforms, and I know Tesla's going to be talking probably a lot more about this now at its March 1 Analyst Day. Autonomous taxi platforms are the convergence of 3 major innovation platforms: robotics, energy storage, and artificial intelligence. Those are 3 different S-curves, and they're going to feed one another. So we think it's going to be pretty explosive.
So why have you been getting out of Nvidia? Because it's considered one of the biggest beneficiaries. You saw the enthusiasm for earnings
Yes.
when they talked about the AI lead that they have.
Yes, and we like Nvidia. We think it's going to be a good stock. It's priced. It's the check-the-box AI company, and rightly so. We own it in other of our funds, ARKQ, ARKW, some of our Japanese mutual funds. So we do own it, but for our flagship fund, where we've consolidated towards our highest conviction names, part of that has to do with valuation. Nvidia's valuation is very high. And on a 5-year look, I think it'll be fine. But some of the stocks we have in the portfolio, the top 5 that Bob mentioned at the outset, they have proprietary data, including Tesla, like billions upon billions of miles of real-world driving data that nobody else has. Most of our companies are going to be sleepers because of that proprietary data. ChatGPT, if you've been reading about it, is really scraping the internet from all its history for information. It is the proprietary data that companies have that's going to make a difference. And the other thing that AI is going to do, I think the killer app, is cutting costs and increasing productivity dramatically. So pretty exciting.
Disinflation taking away jobs, I guess, net.
All of these technologies are deflationary, but it's good deflation because when you cut costs and cut prices, you increase unit growth. So we think we're going to have some explosive unit growth trajectories during the next 5 to 10 years. And in fact, we think that if economic statistics were measured correctly, unfortunately, they're a product of the industrial age, not the digital age. If they were measured correctly, we think we would see much higher real growth and lower inflation because of these technologies.
Well, a lot's been written in recent days just about survey fatigue, right? And what an old school tool that is.
Yes.
And how it's adding to economic volatility, or at least data volatility.
Absolutely,
yeah.
Absolutely.
When you think of Tesla now, do you wish you could have owned more over the years? You wish you could have held on to, I mean, it's already such a winner. It's a decisive winner for so much of your benchmarks.
Yes, it's actually the only stock that is in a benchmark, really, in terms of our flagship. Maybe Zoom, there are 10 basis points in the S&P 500. Do we wish? No, we have. We've been criticized for owning too much, actually, and it has been our largest position for the most part for years. So our conviction remains very high. One of the reasons we do sell as it moves above 10% in the various strategies is that gives us the psychological wherewithal after we've taken profits to buy when it is falling to 100, which it did not too long ago. So that's part of our trading around opportunities that volatility gives us.
How are you thinking about competition that's come online in the last 12 months?
Yeah, we're very interested in the news coming out of this March 1st day. And we think it will be about robo-taxis effectively. Elon has said that he believes that he'll be able to cut the price of a car in half. We think that a robo-taxi could start at $25,000, and if you've got tax credits, that to take you into the high teens. It's going to be very difficult for the competition to beat that. In fact, they won't be able to come anywhere near it, given their current battery technology. And
so not just the dealer network, not just their marketing costs,
no,
just the battery.
The battery is critical, and Elon's riding down the consumer electronics battery curve. Other automakers chose a different curve that was higher cost to begin with. So they're riding down a curve, but Elon, because he's innovating in battery technology, and we'll hear more about that as well, is we believe 3 to 4 years ahead of the competition, which means for the same power and range, another company, if they wanted to price at the same level as Tesla, will have to lose money, especially if he cuts prices in half.
Well, so if they're so ahead of competition, why does he have to cut prices?
This is the beauty of innovation. He's following a learning curve. There's the drive train is following a learning curve, and for every cumulative doubling in the number of vehicles produced globally, costs decline 28%. So he's passing them along. As you'll notice, as prices have come down, his margins have gone up. He's enjoying economies of scale. And we do believe that margins for Tesla are going to become explosive with autonomous mobility.
Well, that's the other knock against your call, which is the robo-taxi thing hasn't happened. And when it comes to autonomous leadership, Tesla itself last week had to recall hundreds of thousands of vehicles because of their, they recognized the NHTSA safety report that they've been mismarketing their self-driving feature.
So just think about that, recall. So quick over-the-air software update. I mean, that's a lot different, right? And the first point, autonomous has
been... Not great, though.
But over-the-air software done. You didn't have to waste time taking your car into the dealer and so forth. In terms of autonomous, we believe that Tesla will launch a national service. That's what all the robots that we're driving right now have been doing for the past 5, 6, 7 years, is collecting data so that he will be able to do that. He and Tesla and the broader team. This is not just about Elon, of course. And autonomous is proven out already, not by Tesla yet, but by Cruise Automation, which is GM's subsidiary. And they were able to launch in 90 days what it took them 9 years in San Francisco. They launched in Austin and Arizona within 90 days. So it has, as always, in the early days of innovation, it goes slowly until all of a sudden it takes off.
So wanted to ask about some of your other calls, Cathie, including some of the Zoom, it's out today, Twilio. Some of these stocks that have been considered pandemic winners, they got such high valuations, which helped your fund during COVID, so much business, and now there's a lot of give back, and they're cutting jobs, and they're trying to rationalize their costs, and their revenues are declining. Why do you still stick with these companies and buy them on the dips if it's hard to imagine they could see better days?
We're looking at what these companies are doing with artificial intelligence and how much data they have to use, proprietary data that no one else has. And we think they are two of the best positioned. If you look at Zoom's patents in the last few years, they are roughly, the patent pending or patent applications, almost half of them are around artificial intelligence. And Eric Yuan, who is the CEO, he started WebEx. He knew that enterprise communications was going to move from hardware-centric and on-prem, think Cisco, into the cloud. Zoom and Microsoft are going to take this market. It's a $1.5 trillion market per year. And so when people say, oh, well, Teams is going to kill it, no one's going to rely on just one service for communications. And we do believe that Zoom is very creative, and with artificial intelligence is going to deliver some very interesting products and services over the next few years, especially when it comes to Salesforce services.
Of the silos of innovation that you watch, and you've talked about them for years, is blockchain still considered one of them? And has any of the allegations of fraud or regulatory risk made it maybe the least favorite son for the moment?
No,
I'm thinking about coin right now.
Actually, we think that what happened last year proved the point. You know, Sam Bankman-Fried didn't like Bitcoin. Why didn't he like it? Completely decentralized, transparent. He couldn't control it. FTX and Celsius and 3AC, completely opaque and centralized. Those were the companies that went under. The blockchains, whether you're talking about Bitcoin or Ethereum and many others, they didn't skip a beat. Transactions did not stop. And I think that has given us a lot of confidence that actually they're on the right track. We think there are 3 revolutions taking place simultaneously. There's the money revolution, which is mostly Bitcoin, a bit Ether. There is the financial services revolution, which is Ethereum, as is this notion of digital property rights. First time. That's Web3. Digital property rights. With an economics background, I know that the best way to lift people and countries out of poverty is to give them immutable property rights. And we think that Web3 is all about bringing digital property rights into this new world.
I also wanted to ask about Twitter, because you do own it in the venture fund,
Yes.
which you recently launched, public
Yes.
and private equities. Word last night that there are more Twitter layoffs, that he just continues to shrink the size of the workforce. How do you think it's going?
I think he had to do some radical cost cutting, that it was completely bloated. And so he's cleaning house, and we do think he'll bring in another CEO once he's cleaned house. And we really do believe that Twitter could work up into a super app. Remember, he got his big start in the payments industry. And so I think we are looking at the possibility of Twitter evolving into something more WeChat-like, WeChat and WeChat Pay-like, than most people understand right now.
I think one of the people to go last night was the head of Twitter Payments, which was one of your, I know that's one of your great hopes for this.
Yes, yes, and I'm sure there is a reason for that, and we will find out, and maybe it has to do with blockchain technology.
Finally, Cathie, you know, we bring you on. We've talked so much about the correction in names that Sarah mentioned. Has any of that experience, say, over the last year and a half, 2 years, changed the way you approach your strategy, your framework? Has there been any learning curve in that for you?
So the one that, if you had told me in early 21, and I remember being on your show in early 21, if you had told me that that we would have supply chain problems for not 1 year, but 2 to 3 years, and that we would have a war in Ukraine, if I'd known that, then what we would have done was increased our weighting of what we call cash-like innovation names. In this case, it would be an Apple or an Nvidia I would put in that category. Very safe, robust, definite story there and so forth. Instead, we did what we always do, and we concentrated towards our highest conviction names, which I think will work out. I think when history tells the story, this shock, the supply chain shock that we went through the last 2 years will prove to be transitory. I know that's a dirty word now, but when I see money growth rates dropping over the last year, I think the growth rate in the money supply has dropped 30 percentage points. You go back through the 1920s, the Depression, we never have seen anything. I think by the end of this year, people are saying, whoops, maybe they overdid it on the other side.
On M2 and
yes,
rates?
M2 and rates.
I don't know. There's increasing evidence that services inflation is
inverted
more
yield
powerful.
curve. The bond market agrees with us. That inverted yield curve, for some reason, long bond holders are willing to take 80 to 85 basis points less for 10 years than the short-term holders.
Well, they think inflation's going to come down.
Yeah. Yeah, one of the puzzling things every morning. What a great discussion. It's great to have you, and I'm glad they gave us some time as well.
Thank you so much.
Cathie Wood.
Bye-bye now.
Still to come, we've got another good interview for you ahead. Cantor Fitzgerald and BGC partner CEO Howard Lutnick joins us. Stocks have lost some of their early gains. We're up 175 still on the Dow, about 0.6% on the S&P. Back in a minute.